In this video, we are going to go over some basic concepts of capital structure and the M&M propositions. As you should know by now, given your previous accounting classes and finance classes, or things we have discussed in this course previously, capital structure, it's the combination of debt and equity. Now, for this definition here, assume preferred stock as being part of equity as well, but that's what it comes down to. So we are going to focus on some specific vocabulary. The value of a firm is going to be defined as the sum of the value of the firm's debt and the value of the firm's equity. No surprises there. If the goal of the firm's management is to make the firm as valuable as possible, then the firm should pick the debt equity ratio that makes the pie as big as possible. Now, I want to make sure there's an understanding of the difference between the value of equity versus the value of the firm. So here we're talking about the value of the firm as a whole to include the value of debt. And that is to create some kind of distinction between what we might consider the value of the stock and the market capitalization. I'm not going to get into the whole theoretical part of the stock price on the market reflects all value and all information, but let's keep somewhat of a separation in our minds between the value of the firm and what would be called the value of equity or the value of the stock or market capitalization. Just so it makes a little sense of what we're going to talk about in this chapter. Stockholder interests. There are two important questions. Why should the stockholder care about maximizing firm value? So you see there's a difference between maximizing the equity value, which is where the stockholder is present in that equation, versus the entire firm value. Because perhaps they should be interested in strategies that maximize shareholder value. We're going to eventually see with a couple examples how it comes together. It is a benefit, but we also got to be careful of what we call transfers of wealth, where the value of the firm may increase, but not in the best direction for the debt holder, not in the best direction for the equity holder. What is the ratio of debt to equity that maximizes the shareholder value? As it turns out, changes in capital structure primarily benefit the stockholder if the value of the firm increases. That's another way to say, remember the pie, let's go back there, is not necessarily 50-50. So what they're saying is that maybe increasing the debt, this red area, while it looks like the value of debt is the one going up, we're going to see how increasing that red area may actually increase the total value of the gray area, even though it plays a smaller part in the entire pie. But if the entire pie grows, then a smaller part of a bigger pie could mean more than a large part of a smaller pie. That's what we're saying. This is a quick way to visualize some of how some of this plays out when you increase debt in the company. Now, there's more to it, of course, but here's one way to start visualizing how these numbers come out. So let's say we got the same company here. An all equity company is here on the left, and a company that has some equity and some debt here on the right. So these are just some key figures. So let's say the company has all assets of $20,000. And those $20,000 in assets all came from equity. So this company did not borrow any money. All money came out of the pockets of investors. So the debt to equity ratio will be 0 because there is no debt. There are no interest rate payments. And in this case, we're going to say 400 shares outstanding. That number could be higher or lower. It doesn't really matter because what matters is the total. The point is that when you take the $20,000 and you divide it by the 400 shares, now the equity is what we're doing here. The share price will be $50. Now, this is an oversimplified example. Of course, there's more elements that come in play when you look at the market price, but let's just go with that for now. So equity divided by shares, share price. Now, what they can do is you can go ahead and borrow, let's say about $8,000 and buy back some of those shares with $8,000, right? And then that will reduce the amount of equity that was needed or that is still in the company. So you still got the same $20,000, but instead of being 0 and 20,000, you have 8,000 and 12,000. Now your debt to equity ratio is 2/3. And the interest rate in this case is 8% because now they have debt and they got to pay that. But what happens is when you purchase back those shares at $50 a piece, you're down now to 400 shares outstanding. So we take the equity and divide it by the shares outstanding, you still get the same $50 per share price. Now, we will see in a little bit how, even though the share price was the same, this 12,000 drop from 20,000 is going to make a huge difference on the return to those shareholders. Now, here we have an example of how things will play out when there's no debt. Let's say the economy could be in a recession, it could be go as expected, as normal, or there was a boom, there was an expansion on the economy where things went better than expected. So we're going to start at the EBIT portion of the income statement, earnings before interest and taxes. Because there's no debt in this example, there is no interest to be paid, so your net income is the same as your EBIT. So earnings per share, what you do is, remember, we have 400 shares outstanding, as in this no debt scenario, 400. So when you divide the 1,000 by the 400, you get $2.50 per share. Return on assets is 50%. How do we do that? We take that net income and we divide it by the total assets, which is 20,000, and that's our return on assets. Our return on equity, because there's no debt and everything is in equity, turns out to be the same as return on assets, because when you divide it by the equity, it's the same 20,000 in the assets because there's no debt. So you get a 5% ROE. So ROA is going to equal ROE when there's no debt. And these are the numbers play out in a recession. If the economy goes as normal, they expect an EBIT of $2,000, no interest, so the net equals 2,000. You do the same numbers. $2,000 divided by the 400 shares, you get a $5 of earnings per share. Return on assets, 10%. The 2,000 divided by the 20,000 in assets that we saw. And as we know now, because there's no debt, your return on equity plays the same. If things go better, earnings per share, 750. 15% and 15%. The 3,000 divided by the $20,000 in assets, and the $3,000 divided by the $20,000 in equity. Now let's see how these numbers change if you do borrow some money. So the EBIT is going to be the same, right? 1,000, 2,000, 3,000, depending on the outcome of the economy. But now we have an interest that we have to pay, and that was the 8% here, multiplied by the $8,000 that were borrowed. So that's how you get the $640 in interest here. So when you take the EBIT minus interest, by the way, there's assumption of no taxes here, you get the net income of $360. But now remember that because you borrowed money and you purchased back some shares, you're down to 240 shares. So the earnings per share is your 360 divided by the 240, you get $1.50 earnings per share. Your return on assets is 1.8% because you take the 360 divided by the $20,000 and you get the 1.8. However, in this case, because there's debt and your equity is now down to 12,000, the net income is going to get divided by the equity. So your return on equity is going to be higher than return on assets. And it shows here 3%. Because now we divided by the $12,000 in equity, not the 20,000 we had in the previous scenario. And then so on, you do the same calculations here. And the same here. Now, what I want to point out now is not just only the ROA and ROE are going to be different because of the debt element, but when we compare to the no debt scenario, let's look at the recession. ROA and ROE, 1.8, 3%. In recession, you ended up with less return on assets and a lower return on equity. However, on the expected or normal, or the expansion better than normal, you will notice that, yes, your return on assets became less than the no debt scenario because you divided by all assets anyways, but your return on equity now actually became a higher number than the 10%. Same thing happened here. 19.7% versus 15%. So the moral of the story is, when you borrow money, you are doing financial leverage. You're practicing financial leverage. When things go, I guess let's say, not as well as you expected, then you would expect a lower return on equity than if you didn't have any debt. But when things go normal or better, you get a better return. So this is an example how shareholders benefit from there being some debt, a value of debt in the company. The idea is that in one scenario, $20,000 came out of the pockets of the investors. In the other scenario, debt only $12,000. So while your net income was lower than the no debt scenario, when you do it dollar per dollar that came in versus the dollar that where it was invested, you end up with a higher return per dollar invested. And that's what the ROE is looking at. And if you look at the earnings per share, same situation happens. When things don't go too well and you have financial leverage, the earnings per share came lower. But once things are normalized or better than expected, your earnings per share then jump up. And that's what those numbers mean or are doing. A lot of people get worked on, but if you're making less money, why would you do that? Well, you borrow money. You might be making a less total amount, but when you look at the amount you made per dollar invested, you came out with a higher number. In a more broad concept, a broader way to view it is, when you do it this way with a debt of $8,000 and you only put $12,000, that's $8,000 more that you can invest somewhere else and make a return elsewhere as well. So you can still invest your entire $20,000, but make more money that way. If you were to duplicate the situation, you end up making more money by having multiple investments that have debt versus just having all your money in one place. And that's not even considering that you're diversifying your portfolio. But anyways, there's a quick example of the simple way to look at return on equity, where financial leverage, borrowing money, can increase the value to shareholders, as explained earlier. So moving along, M&M, it's a nickname for a couple of researchers that developed some mathematical proof about the value of the company in scenarios with and without taxes, and if you add debt or not, and how the value changes, and that the main driver, or one of the main drivers of the added value, can come from the tax benefit. to all investors, not just shareholders. That's important to understand the difference here. Okay, so there's some assumptions. Now, in economics and finance, we typically, when we work with something new or unique or trying to show the value of something, we will start with the most simplified scenario to get to the fundamental of it. What happens is then later you can add the nuances of dividends, income taxes versus capital gains taxes, and so on and so forth. But when you see this list of assumptions, yes, it's unrealistic. The real world does not operate that way, but it eliminates what we call noise, so we can actually look at the essence of the item. Because once you have that one proven, then you can just adjust your formulas and calculations according to real world scenarios where variables change all the time. So here we're going to start with homogeneous expectations, just what it means, same expectations across the board. Homogeneous business risk classes, just what it means, same business risk across the board on the study. Perpetual cash flows. That's a way to say that we expect the company to live forever. We don't expect a bankruptcy case, and in this case also steady cash flows. Of course, like I said, as you move forward and more and deeper analysis, then you would adjust those items. Perfect capital markets, meaning as in, no frictions, no arbitrage, no all those good things that you hear about. So everything is pretty much perfect in the sense that there's no leakage, no information barriers, et cetera, et cetera. Perfect competition, just what it sounds like, and just like you learned in your economics class. Perfect competition, in other words, nobody really has a market advantage over others. Firms and investors can borrow, lend at the same rate. Yes, in the real world, firms do have different business risks, so they'll be offered different rates, or they might be in different states, different geographical locations, different industries, all kinds of different things. But for this example, we just, like I said, keeping it as simple as possible. So everybody's exposed to the same interest rates. Equal access to all relevant information. That is, I guess, related to the perfect capital markets that we spoke about. These are the items under perfect capital markets. So we're talking about strong form, market efficiency. Like I said, it can be adjusted afterwards, but for now, we don't want all that noise. No transactional costs and no taxes. So that's the base form. Let's start with that. When none of those things happen, we argue that the value of the levered firm, in other words, VL, meaning the value of a firm with debt, will be the same as the value of the unlevered firm, a company with no debt. We're talking about the value. This is different from what we talked about of return on equity. That was just showing how shareholders can benefit from the overall value going up, even if some of that value goes to the debt holders. Okay, so in that situation that we spoke about, with no taxes and all those perfect scenarios, there will be no difference. Whether you borrow money or not, the total value of the firm will be the same. And that kind of reflects here. If you look at the assets, it's a way to look at it. With debt or no debt, the assets were still $20,000. If you want to kind of somewhat look at it from that angle. Also remember, and I'm going to review here, there was no taxes involved in this example. So moving forward, we're also going to talk about what we call let's recap. The M&M proposition 1 with no taxes, the value of the levered firm equals the value of the unlevered firm, as in financial leverage. The second proposition is that leverage increases the risk and return to stockholders. So, as you know from all the previous financial talk, risk and return are always tied together. Higher risk should equal higher return. Now, do not confuse value with return. Here we're saying the value is the same. Here we're saying is that the return goes up. So that would be like saying the value stayed the same on both, scenarios with and without debt, but the ROE was not the same. As debt went up, the ROE can go up. Of course, recession being the risk side, that if things go bad, things go worse as well. So that's a representation of higher risk, higher return. Higher risk could also mean lower returns or even losses. And that's what they're expressing here with this formula. Just so you know, this is just the same weighted average cost of capital formula, just turned around algebraically to put the letters in this order so we can talk about RS, which is the return on the levered equity. So the idea is that as debt goes up, those are the B's, that B here, everything else stays equal, that number is going to go up. That's all it's saying. So both together here, so you can see them. So the same propositions that we spoke about, value here with no taxes is the same. The return in a no tax situation goes up as debt goes up, which it was in practice here with these numbers. Now here's the same two, but now we have taxes involved. So we're saying that the value of the firm with debt increases as you add debt to it. Or let's say add leverage, so shift from equity to debt. And the reason is because now we have that tax element there. The idea is that there's a portion of cash that is always going to go out of the company. The question is, are you going to pay that to the government, or are you going to pay that cash to your investors? And we call that cash flow to investors. Now, I'm not saying that all taxes could go to investors. In some very unique and special circumstances, it could happen. But at least, for sure, there's a portion of cash that is always going to go out to the company. And you choose, depending on your leverage, you're pretty much choosing when you decide on a capital structure, how much of that cash that could go to investors are you going to decide, no, just give it to the government, or no, let me give it to investors. Now, this cash, the investors we're talking about is not stockholders. It's the actual debt holders, the ones that buy the bonds, but they're also investors. So if you can move more of that cash flow to investors, in this case, the bondholders, instead of to the government, well, the value of your firm is higher because the firm is generating more cash to investors. And as we know, is that then if the debt is a healthy level of debt, the shareholders also benefit because their ROE goes up. And that's what this is capturing there. Okay. Same formula as you saw here when we discussed the return on equity. But now we have that 1 minus T in there. Very similar to the weighted average cost of capital. The formula just turned around. And that is the general idea of what we're trying to say here. When there's taxes, your value of the firm goes up with debt up to a point. Too much debt can be bad for the company because the risk goes too high. And what this proposition is saying is that because you're moving cash that would otherwise go to the government, but you give it to investors, your firm is more valuable to investors now. This is this graphical representation of what happens. In this case, a firm without debt, so much cash is going to go to stockholders and a chunk is going to go to government and taxes. But if you borrow money, now there's cash going to stockholders, a little less, but we'll talk about that again in a second. But there was a big chunk of cash going to these debt holders. Those are also investors, and less cash to the government. So the idea is that from this amount of cash going to investors versus this amount of cash going to investors, this one has a higher value to investors because, as you can see, the green and the blue add up to more than the blue here. So the firm becomes more valuable. And as we saw from these numbers, while the total cash to investors might be less here, the cash per dollar investor is higher. So they benefit as well. They got more money per dollar invested. And that is the logic of these propositions in capital structure. Remember, I'm going to go back here. Those are the basic concepts. There's a lot more to capital structure, and it's a very complex scenario. A lot of research on this about optimal capital structure, and a lot of different competing theories. But we will stop the video here. See you on the next one.